Convenient, easy to use, and always there when we want it. But recently, the service hasn't been there when we've needed to access our money. In the most recent spate of banking service disruptions, around 2.5 million payments and ATM transactions couldn't be completed. And as a result, the Monetary Authority of Singapore has imposed penalties on one of the two banks affected, DBS.
More direct impact will of course be a higher compliance costs, higher operational costs, and some costs having to be set aside to sort of enhance their system resiliency. But I believe the scope of the costs should not cause too much of a dent as relative to their overall earnings. And the MAS ban on acquisition is also short-lived. It doesn't last, over a prolonged period of time. And I think DBS focus currently is really more on trying to integrate the previous acquisition into its businesses as compared to seeking out new ones amid the current environment.
And there are other worries as well. On the property front, cooling measures and high interest rates could hit loan demand. Already industry watchers tell us that they're seeing some signs of buyer fatigue. Now, if banks have to set aside more cash to cover bad loans, that could come at the expense of their profits. So, do they have what it takes to weather a downturn?
They have a very strong capital buffer to really weather against these kind of financial risks. And I think our three local banks have also been very prudent in terms of unwinding their previous loan loss provision from the COVID-19 period. And in recent quarters, they have also set aside more cash. So overall, I will believe that they are really, sort of well capitalized and really very well positioned to really weather any, economic downturn ahead.
Despite expectations that earnings have peaked, DBS, UOB and OCBC continue to deliver strong profits this year. The banks are set to benefit from stable net interest margins, or NIMs, as interest rates stay higher for longer.
The NIMs will remain high all the way to the second half of 2024 because of the higher for longer rates, and the banks are all guiding for the same as well. Yeah, and with a recovery in fee income, there will be another boost to the bank's earnings. The current account savings account ratio, it has dipped quite a bit compared to the COVID times. But if you look recently, they have managed to level it off, and that means that their funding costs have sort of stabilized, which is why they are able to maintain their high NIMs. You'll see a peak in the NIMs in around 2024, and definitely in the second half of 2024. So rates will most likely not drop in the first half, but in the second half, when we start to see the rates drop, we will see NIMs start to dip a little bit.
Analysts expect the bank's earnings to taper off next year, as the prospect of recession and downside risks to the global economy could weigh on loan growth.
One of the things that people look at is the yield curve re-steepening, and this has kind of occurred around mid of this year. So usually the data shows that after a yield curve re-steepening, about 6 to 12 months on, that's when the recession hits. So this puts us about 2024, there's possibility of a recession for the US, that is. So I think all of these macro indicators are signaling this kind of possibility.
As banks look to grow their fee income, they will be targeting new drivers for growth.
So the latest bank's earnings all sort of point towards wealth management as kind of a bright spot, and they do see the potential there. DBS, right? Earlier this year, they announced the first ever multi-family office. So that was a great innovation, I feel, because this will really help address high net worth individuals' demands who perhaps don't want to set up their single family office because of cost or tax reasons. And if the banks can have this kind of response to the customer needs, I do think that the wealth management will be a good space.
Experts say the three banks are also well positioned to deliver sustainable long-term growth. They've also traditionally been popular with dividend investors.
So the banks are not trying to say anything about whether they're going to increase dividends, but there's definitely this possibility. So now we're looking around 4 to 6% dividend yield. which is very high for a bank. Our pick would be OCBC. OCBC being the cheapest, among the three banks. And of course, their dividend yield is also very high. It's at around 6% now, compared to the other two at 4 to 5%.
From the medium to longer term, I think all three local banks continue to be very attractive additions to one portfolio, largely based on their stable dividends, their more resilient earnings, along with their strong capital position. And I believe our three local banks are also in a very sweet spot to tap on growth opportunities across the region, and they have already started to move in terms of stepping up their offshore expansion plans. And I believe that will continue to provide somewhat of a growth catalyst to sustain their earnings momentum over the longer term.